September 15th, 2008, 7:30 a.m. Lisa Martinez walked to her mailbox in Phoenix, Arizona, pulled out a thick envelope from Bank of America, and her hands started shaking before she even opened it. She knew what it was. She'd been dreading this moment for 6 months. Inside was a notice of default. The bank was starting foreclosure proceedings on her home. The house she and her husband Mark had bought 3 years earlier for $425,000 was now worth $180,000. They owed $405,000 on the mortgage, were $245,000 underwater, and they couldn't make the payments anymore. Lisa sat down on her front steps and cried, not just for the house, but for what was about to happen to her family. Within 8 months, they'd be evicted, their credit destroyed, their savings gone, living in a rental apartment, and their 2 kids would have to change schools, leave their friends, watch their parents' marriage nearly collapse from the stress, and all because in 2005, a mortgage broker told them they could afford a house they absolutely could not afford. If you want to understand what really happened during the 2008 housing crisis, through the eyes of real families who lost everything, hit that subscribe button and smash that like button. Right now, drop a comment telling me if you or someone you know lost a home in 2008, because what I'm about to tell you isn't about Wall Street or credit default swaps. It's about millions of American families who had their lives destroyed by the biggest financial crime in modern history, and most of them never saw it coming. Let me take you back to 2005, the peak of the housing bubble. Lisa and Mark Martinez were both 32 years old. Lisa was a teacher making $42,000 per year. Mark was a sales manager making $68,000 combined household income of $110,000 solid middle class. They'd been renting a 2-bedroom apartment in Phoenix and wanted to buy their first house. Their kids were getting older. They wanted a yard, wanted to build equity instead of paying rent, wanted the American dream. They went to a mortgage broker who looked at their income and said, "You can afford up to $500,000. Lisa said, "That seems really high." And the broker laughed and said, "Everyone feels that way at first, but trust me, home prices only go up. You'll refinance in 2 years when the house is worth more, and besides, we can get you an interest-only adjustable rate mortgage. Your payment will only be $20,100 per month for the first 5 years. That number seemed manageable, close to their rent. So Lisa and Mark started looking at houses in their approved price range. They fell in love with a brand new 4-bedroom house in a subdivision, 2,400 square feet, granite countertops, 3-car garage, community pool, asking price $425,000. They made an offer, it was accepted, and 45 days later they signed a stack of documents they didn't fully understand, moved into their dream home, and believed they'd made it. They were homeowners, building wealth, living the American dream. What they didn't understand was that they'd just signed a financial time bomb that would explode in exactly 3 years. The mortgage was an ARM adjustable rate mortgage with an interest-only period. For the first 5 years they only paid interest, no principal, so they weren't actually building any equity. The house had to appreciate in value for them to build wealth, and for the first 2 years it did. By 2007, their house appraised at $485,000. They'd gained $60,000 in equity on paper. Without paying down a single dollar of principal, the broker had been right. Home prices only go up, or so they thought. Then in late 2007, the market shifted, new home construction stopped for sale, signs stayed up for months, open houses had no visitors, prices started dropping, and by early 2008, Lisa and Mark's house was worth $350,000, then $280,000, then $180,000. They watched their equity evaporate. $60,000 in gains became $245,000 underwater. But the real disaster was the mortgage payment. In year 6, the interest-only period ended and the payment reset. Suddenly their $2,100 per month payment jumped to $3,400 per month. And the interest rate adjusted upward from 4.5% to 7.2%. That's an extra $1,300 per month they didn't have. Mark's sales commissions had dried up because the economy was collapsing. Lisa's teacher salary had been frozen. They were making less money. And the mortgage payment was 62% higher. The math simply didn't work. They tried everything. Called the bank to request a loan modification. The bank said they didn't qualify because they were current on payments. Tried to refinance. No bank would touch them because they were underwater. Tried to sell the house. But there were 47 other homes for sale in their subdivision alone, and none were selling. They were trapped. For 6 months, they drained their savings to make the mortgage payment, $15,000 in emergency funds gone. Then they stopped contributing to retirement accounts. Then they took on credit card debt. Then they borrowed from family. And finally, in September 2008, they missed their first payment. They simply didn't have the money. And that's when the foreclosure letter arrived. The bank didn't care that Mark had lost his job, didn't care that they had 2 kids in school, didn't care that they were trying, the contract was clear, missed 3 payments and foreclosure starts by December. They'd missed 3 by February 2009, the bank filed foreclosure. By June, they received an eviction notice. And by July, a sheriff's deputy knocked on their door and told them they had 72 hours to vacate the property. The psychological damage was worse than the financial damage. Lisa developed anxiety and depression, couldn't sleep, lost 20 pounds from stress. Mark started drinking heavily. Their marriage nearly ended because they fought constantly about money. Their daughter's grades dropped. Their son started acting out at school. The entire family was traumatized, and the shame was crushing. They felt like failures. Even though millions of families were going through the exact same thing, they'd believed the American dream, and it had destroyed them. They moved into a small rental apartment. Their credit scores dropped from 720 to 480. They couldn't get approved for anything, 7 years of rebuilding ahead of them. And all because a mortgage broker in 2005 had told them they could afford a house they absolutely could not afford. But here's what made the 2008 crisis truly criminal. The banks knew. The mortgage brokers knew. The rating agencies knew. Everyone knew that millions of families were being sold mortgages they couldn't afford, but they didn't care because they weren't holding the risk. They were bundling these mortgages into securities, selling them to investors, collecting fees, and passing the risk down the chain. By the time the mortgages defaulted, the brokers had their commissions, the banks had their fees, and families like the Martinez family were left holding the bag. Over 10 million American families lost their homes to foreclosure between 2007 and 2012. That's not a market correction. That's systematic fraud enabled by deregulation and incentivized by profit. Let me tell you about Richard and Susan Thompson in Las Vegas. They bought a condo in 2006 for $310,000 with 0 down payment. Literally no money out of pocket, just a signature on a Nina loan, no income verification, no asset verification. The broker didn't even ask for pay stubs. By 2009, their condo was worth $87,000. They were $223,000 underwater. They walked away, just mailed the keys to the bank, and left strategic default, they called it. Why pay $310,000 for something worth $87,000? Their credit was destroyed, but at least they stopped the bleeding. Or consider David Chen in Miami. He bought 3 investment properties in 2005, all with adjustable rate mortgages, all with 0 down, total purchase price $1.2 million. By 2008, they were worth $420,000 combined. He owed $1.15 million. All 3 went to foreclosure. And David filed for bankruptcy at age 43, wiped out financially because he believed real estate always goes up. The human toll was staggering. Suicide rates increased 13% during the foreclosure crisis. Divorce rates spiked among couples who lost homes. Domestic violence increased. Children's educational outcomes suffered when families had to move and change schools. Entire neighborhoods became ghost towns with rows of foreclosed homes. Property values collapsed. Cities lost tax revenue. Schools lost funding. The destruction rippled through every aspect of American society, and the people responsible, the bank executives who pushed these predatory loans, the rating agencies who gave AAA ratings to garbage securities, the regulators who looked the other way. None of them went to jail. They kept their bonuses, kept their jobs, and the families paid the price. So what's the lesson? How do you avoid being the next foreclosure victim? First, just because a bank approves you for a mortgage doesn't mean you can afford it. Banks were approving people for mortgages that required 45% of gross income. That's insane. The rule should be no more than 28% of gross income for housing. Lisa and Mark were approved for 2.5 times what they could safely afford. Second, never trust stated income loans, 0 down payments, interest-only mortgages, or anything that sounds too good to be true. If you can buy a house with no money down and no income verification, you're being set up to fail. These products only exist to extract fees from you before you inevitably default. Third, Assume home prices can drop 50%. Everyone in 2005 believed prices only go up. They were wrong. Prices dropped 60% in some markets. If you can't afford the house at half its current value, don't buy it. Fourth, always get a fixed-rate mortgage. Adjustable rates are designed to trap you. They look affordable at first, then explode. Lisa and Mark's payment jumped 62% when it reset, killing them financially. And fifth, if you're underwater on a mortgage, understand your options: loan modification, short sale, strategic default, bankruptcy. Don't just keep draining savings trying to pay an underwater mortgage. Sometimes walking away is the smart financial decision, even though it feels like failure. If you found this valuable, smash that like button, subscribe for more true stories from American financial crises, and share this with anyone buying a house, because the 2008 housing crisis destroyed 10 million families, wiped out $9 trillion in wealth, and it was entirely preventable. It happened because banks put profit over people, because regulators failed, because everyone believed the lie that real estate always goes up. Don't let it happen to you. Learn from Lisa and Mark. Learn from the millions who lost everything. The next housing crisis is coming. The only question is whether you'll be prepared or whether you'll be the next family receiving a foreclosure notice, wondering how your American dream turned into your worst nightmare.